Hey, good morning, everyone.
Morning, Professor.
Morning, Professor.
Yeah, good
Good
morning. Good
morning.
morning.
Good
Good
morning.
morning. How's everybody? Well, so you may understand, I'm sure you all understand that today is the last online class. It's not the last day of class. And our last day of class is this coming Thursday. And on that day, we're going to have face-to-face class. Some people ask me, do I have to be, do I have to come to school on that day? And I've been telling you, well, if you have perfect attendance so far, and you've never made any absence, and you all know in the syllabus it's been um, clearly stated that you have three absence grace period, right? And if you haven't used any one of them, you're entitled to exercise one, absence at least, right? So I don't need to even explain this. I mean, you can, figure it out. So, but if you have made so many absences, uh, obviously, making there's a point beyond which, making any more absence. I mean, making it any more absence or any presence won't make any difference because you've made so many absences. But still, one uh, absence will still uh, make you miss that 0.167 point, and one presence, one attendance will give you still that extra 0.167. Anyway, you're all grown ups. I mean uh, uh, not socially. Uh, I don't know if legally grown up is like 21. I don't know. Um, but you're all above 18, 19, so it's uh, it's at your discretion. um, but the class will be in let me just why am I just so let me go to the announcement. The classroom will be Murray 1007. Okay. Murray 1007. I don't know if this is a smart classroom or computer lab, but um, at least if it is a smart classroom, then we can use. I can at least show you something. Well, through the projector, but I will see you there. Okay, this Thursday. Alrighty, that's it. And
Professor, I have a question.
yeah, yeah.
Will we have the final? Is it going to be that day in class?
No, the final instruction
Okay.
already went out. Didn't you get it? The
Oh
final
yeah, I
instruction.
did. Sorry.
Yeah, the final is on Connect, so you don't. It's not in person. I mean, you can take final, right? Um, from home, right? Where is that final instruction? Yeah, it went out Friday, right? 12:10 through Sunday, 3-day window as usual. All right. And okay, so let me just quickly check uh, what we talked about in the last. I think we we discussed, bond, municipal bond, and I believe last time, 1202. That was 1 week of last Thursday, right? 1202. Make it a little faster.
Adjustment to the part at higher level.
Oh, tips, yeah.
And you might wonder,
Mhm.
since like over rational, but because they want to take advantage.
Okay.
Like strict discipline. You shouldn't be swayed up.
Yeah. So, yeah, we went, far enough, I guess. We talked about the valuation of the zero coupon bond. So now let's think about the valuation of the coupon bond this time. And we already understand. I mean, this is the reason we did, all those, financial math, present value, future value, before anything else. I mean, before, bond valuation. And after bond valuation, we have stock valuation, and everything is basically discounted cash flow model. So present value is, the name of the game. Now, so next question is, so a bond has 10 years to maturity, a par value of $1,000, and a coupon rate of 10%, right? In this case, what cash flows are expected from the bond? Yeah, of course, $100, because it's 10%, coupon rate is 10%, the coupon interest is $100 at the end of every year for the next 10 years, right? 100 for the next 10 years. And at the end of year 10, you will have par value of 1,000, maturity value of 1,000. So we have two types of cash flows here, right? Two types of cash flows, isn't that right? One type of cash flow is annuity, right? That's annuity exactly. What is an annuity? I mean, in the previous classes, when I asked, what is the name of this type of cash flow? None of the students, hardly. It's something we just did a week ago, and then the students cannot come up with the term annuity. I mean, this type of regular amount paid, regular payment or deposit at regular interval, that's what is called annuity, right? So all these coupon payments are annuities, basically. And then the last final face value of the bond, that $1,000 must be discounted all the way back 10 years, right? All the way to time zero, back to time zero. That's single cash flow, right? Present value of single cash flow, right? Present value of single cash flow. So think about it. To value the bond, we need two models: present value of annuity and present value of single cash flow, right? Therefore, yes, this is the formula for present value of annuities, and this is the formula for present value in single cash flow, right? So then, using that model, let's do this one. Consider 20-year bond with 7% coupon. If discount rate is 6% annually, okay, find the price of the bond. That's the question. But here, there is one thing that is very unusual. What's unusual is it says discount rate is 6% annually. Now think about it. I told you already that this is not the way it is worded. Um, they never say it directly. They never say directly, straightforward, that the discount rate is such and such. And I told you there are roughly three ways that the discount it is worded. Roughly three ways it is worded, which is what? Um, roughly three ways. Um, one, um, the bond is priced to yield 6%. That's number one. Number two, the comparable bonds or similar bonds pay 6%, right? Number three, prevailing market rate is 6%, right? That's all the ways, basically, uh, not more than those three ways. I haven't seen any problem that is worded differently. But those wordings are the ways to say this is the discount rate. It never says, right? None of the problems I have seen all my life as an economist, for the last, 30 years as an economist, have I seen any problem that says use this as a discount rate. It never says, right? But this example to make it easier for you. So you can say, and then one question here. Now this bond pays 7% coupon interest rate, but the discount rate is 6%. So what do you think? Is this going to be a premium? Is this going to be a premium bond or discount bond? Anyone? Anyone? This is a point giver, actually. This is a point giver. How many people do I have here? I have 8 people. Can anyone? This is also something we discussed in the first topic. What makes the bond a premium bond or discount bond? No one? Angelica, do you have?
A discount bond makes it like less.
Yeah, less than what? Less than what? Discount bond makes it less than what?
Then less than its value? No.
Less than its what value? I mean, what value are you talking about?
Can you go back to where you were?
Oh, my question was, you mean the PowerPoint or?
Yeah.
You mean this? Yeah.
It makes it less than the.
Less than what?
This is second
Basically,
period.
Who was that? What did you say? Can you repeat that? That was a second voice. That was a second voice. And who said that? Someone said something. Second, that was a second voice. Okay. First of all, a discount bond is the bond that sells below its par value. Below its par value, and par value is what? Par value is, what is the par value of a bond? Par value is the same thing as maturity value or face value or redemption value. So what is the par value? Anyone? There's no one who can. Jeremiah. Are you there, Jeremiah? Carolis, are you there, Carolis?
yeah, I'm here.
Yeah, Carolis. What is the par value of a bond?
You said what? The what?
What's the par value? What's the par value of a bond?
Let me see.
Oh, come on.
The
Huh?
is the wait, I'm sorry. Is the par value like the nominal value?
Yeah, you can say you can call it nominal value, but it is not one of the names, you know. Par value is always fixed. Par value is the face value of the bond, face value,
Okay.
or the maturity value, what you get at maturity, or redemption value, because the issuer of the bond redeems it by paying, I mean, if you borrowed money, if you have debt, you will have to pay it back, right?
Yeah.
And bond is what? Bond is like a uh, paper certificate that says I owe you this amount. So when you pay back, you redeem that paper, right? That certificate. So that's why it's also called redemption value.
Okay.
So what is the par value? Maricel, are you there, Maricel? Maricel, how about you, Naomi? Naomi, are you there, Naomi? Naomi? How about you, Nicole? Nicole, are you there, Nicole?
Hi, I'm here.
Yeah, hi, Nicole. So what's the par value of a bond?
It's the face value, or I think you said the maturity value
Yeah,
as
yeah,
well.
yeah. Yeah, yeah, that's just the definition, right? But
Hmm.
in dollar amount, what's the face value of the bond in dollar
Oh,
amount?
in the problem that we're doing?
Yeah, yeah, yeah. Or not only in the problem we are doing, but in general.
Did you just say that? Because I might have completely missed that part.
What is the par value of the bond? And I'm not talking about I'm not talking about it only in the context of our
Mhm.
problem, but in general as well. What's the face value of the bond? Hmm?
The-
Okay. Oh,
It's
come on. Out of 8 people, no. Okay,
is it
Noel,
usually?
yeah.
Oh, sorry.
Noel,
Is
yeah,
it
go
is it
ahead, Noel.
$1,000?
Yes, Noel, $1,000. Yes, the par value of the bond is $1,000. Okay, Noel, you get 0.25 for that. Yes, so that means a discount bond is the bond that is priced, right? Or selling, priced to sell, priced below $1,000. A premium bond is a bond that uh, is priced to sell above that $1,000, right? That's the par value. And I told you the only exception to that $1,000 is the municipal bond. And only municipal bond has a different par value. And in municipal bond, it's $5,000. Okay? So my question was eventually then, going back to so in this case, without any calculation, without doing any calculation, you can still tell already whether this is going to be a premium bond or discount bond. And this is also something we something we discussed in topic 1 in macro ROI and macro economy, right? We did that. So just from this, right, 7% coupon rate and 6% discount rate, you can tell already if this is going to be a premium bond or discount bond. So what's it going to be? Discount premium bond or discount bond? Anyone? How about you, Nikori? Nikori, are you there, Nikori? Nikori?
Yes, I'm here.
Yeah, hi, Nikori. So what do you think? Do you think this is going to be a premium bond or discount bond?
Can I see the screen again?
Is this going to be a premium bond or discount bond? Did you see the PDF file? Did you look at the PDF file? Yeah. Coupon rate is 7%, discount rate is 6%. From those two initial conditions alone, you should be able to tell whether this is going to be a premium bond or discount bond. Anyone? How about you, Noel? Noel?
I'll just go out of, I'll say premium.
Premium, yeah. How? I mean, Noel, did you just take a guess or was there some logic to that?
I'm not gonna lie, I low-key did take a guess, but I also feel like it just made more sense for it to be a premium.
Okay, why does it make more sense? I mean, that's the logic. I mean, there must be some reasoning behind it. You said it makes more sense for that to be a premium bond. Then there must be some reasoning behind it, right? What is that reasoning?
Yeah, I don't know how to explain it, but all right, can you go back to the other screen?
Does that happen when they're trading the market?
Who said? Can you say that again? Who said it?
It depends the premium bonds or the discount bonds. It depends the trading of the market.
No, Jeremiah. It doesn't depend on the trading. It is already, I mean, if you're by trading, if you mean demand and supply situation, yes, it's it depends on the demand and supply situation, but then demand and supply is already in this case determined. Something determines, something drives. I mean, not determined, but something already drives the demand. Something drives the demand already. Even though it was a lucky guess, Noel, I'm still giving you 0.25 for that answer. So you got 0.5 in total. Yeah, I'm back in this screen. So can you come up with any reasoning?
Yeah. Okay.
Yeah.
Because the bond has with the coupon is a higher percent than
You are right, exactly.
know.
Yeah, that's the logical reasoning. Did everyone hear Noel? Noel, can you repeat that again? Can you repeat that
Yeah,
for
so
everyone?
that the bond with the 7% is a higher like discount than the 6%.
Not higher discount, but
Or
higher
yeah, like
coupon interest.
higher coupon interest. That's what I meant to say.
Higher coupon interest rate then?
Oh, I'm sorry. Then the other
Higher
one.
coupon interest rate then what? Higher coupon interest rate then?
I'm not sure.
What do you mean? You
Did I not say it though? I'm confused.
Yeah, you said it. You said it. So obviously you said 7% is higher
Right?
rate than
Than the 6%, right?
Yeah. So okay, so for that, I mean, this becomes a 0.55 point answer, right? It was a 0.25 point answer previously without reasoning. With the reasoning, this is a 0.5 point answer. Yeah, exactly. Look, discount rate is what? What did I say? What did I say is normally the wording for discount rate? I told you they never say straightforward this is the discount rate. Usually the way it is worded that the bond is priced to yield, right, 6%, or comparable bonds or similar bonds pay 6%, or prevailing rate in the market is 6%. So in other words, what does that mean? First of all, comparable bond or similar bond means what? The bonds in the same risk category. The bonds in the same risk category, right? The bonds in the same risk category means what? Like, if this bond is a AAA bond, other AAA bonds, AAA class, pay on average 6%, right? So that means AAA is the highest credit rating, right? So the safest bonds, all other, AAA, the safest bonds pay on average 6%. But then what does this mean? This bond is paying 1% more. Then what's going to happen? The demand for this bond would be will go up, right? I mean, think about it. You want to put your $10,000 in a bank, and there are like five, six banks in your neighborhood. What would you do? Where would you go? Huh? And you want to deposit, 10,000, and the savings, if there are savings interest, on average, all these banks on average, pay 6% interest on your deposit, but a particular bank, Bank X, is paying 7%, right? Then where would you take your money to? You would take your money to Bank X, even if it is 1% higher. I mean, why would you put your money? Why wouldn't you put your money into a bank that pays higher interest rate? That's the same rationale behind it. Okay, so they will all go to this bond. The demand for this bond will be strong. It pushes up the price. Right? Price of this bond will be pushed up, and it will be pushed up even above the par value, because it's worth it, right? If the coupon is 6%, as the average for this coupon rate is 6% as the average for this class, then it will be exactly $1,000, because 6% is the discount rate. So if you discount it by 6%, if you discount all the 6% interest by 6%, it will have to be the net effect of all this interest will be zero, right? So it will be exactly only 1,000, whereas if it is paying something higher than the discount rate, then mathematically the present value will have to be greater than the 1,000. That's the logical reasoning behind it and mathematical reasoning behind it. Okay. All right. And then here, our timeline. You might think, 20 years. So we will have 20 years on the timeline, and the discount rate will be 6%. But actually, if you must remember that the bond is on a semi-annual cycle. In other words, bond pays interest semi-annually, not annually, right? We can use annual assumption only for simplification, but in reality, since bonds are on a semi-annual cycle, paying interest, semi-annually, right? On your timeline, there won't be 20 notches, but 40 notches. That makes sense? Every semester, so 40 semesters. And then every 6 months, every semester, you get $35, because annually is 7%. So annually the interest is $70, right? But then it's half year, so $35 every 6 months. right? So then if we calculate this, and then they have they did the this formula, this is just another variant of this formula, but this looks very complicated. So don't follow this because that's unnecessarily complicated, right? But we'll just do it like this, and then we're gonna do that on Excel. So I want you to download, and this file is always there. I don't know if you've ever, I've been telling you to download it so many times. It says clearly, please download the above files and use them with the video. It is imperative. And I don't know how many of you have actually downloaded and worked on this file. So here, if you please download this file. Okay, download this file. And when you download it, I don't know if it is all blank or I'm just
Professor, I have a question.
yeah. Oh, this is weird. This shouldn't be. It's all filled in. This is not right. Yes. What is the question? Go ahead.
So the practice chapters, I think they're called, on Connect, right?
Mm-hmm.
So on top of whatever, they say that they'll be added to our grade as like extra credit or like fill-ins or something like that. Is it already added or is it going to be added at the
No,
end?
no, it's not added yet because until the final, uh, uh, I don't collect the data until the final, and after the final, I collect all the data. I collect the final data, and I will collect all the chapter problem data. So it will be after the final, because
All right.
until then, you have time to do the. You have some people are still doing it. There's no point in collecting the data until everyone has submitted, until the last day of class.
All
Okay.
right. Okay. Yeah.
Hmm.
Thank you.
You're welcome. So okay. So if you download it, you will find this file, but it is already. You see, it must be all already filled in, but I want you to delete all the highlighted cells. The file should have been uploaded with all the these things already out. Let me, excuse me. Oh, so I think I should uh, upload it again. Let me correct that. Where is it? Oh, I guess it's not there then. Okay, I see. So let's do. Let me. Okay, this one. So now it must be all, blank, right? So if you, so do you have this file in front of you now? Do you have this file in front of you? Hmm? Okay, I can't see that. I can't see it while I'm, on a different screen. So say that. Say, let me. Somebody. Angelica, you said yes. And what about other people? Do you have it all in front of you? Hmm? Why everyone is so quiet? I will have to assume that everyone has this file in front of you, in front of them. So let's go to row 8. This is exactly our problem. Isn't that right? This is exactly our problem. Face value 1,000, coupon rate 7%, compounding frequency. M is compounding frequency, right? 2 per year because it's semi-annual, right? Semi-annual. Timeline 20 years. APR, it's annual. This is the yield. Sometimes I would call it yield to maturity, right? But for now, let's say APR because it's annual percentage rate, and then half year rate. So first, let's find. We will need to first find the payment, right? We'll need to first find the payment, which is coupon. That's coupon payment. That means face value times 7%. But that's annual. That's annual thing, right? So we'll need to divide it by 2 to make it semi-annual. $35 semi-annually, right? And then N is 40. We know that because over 20 years there are 40 semesters, which is 20 times. I'm sorry, 20 times 2, right? And then the periodic rate. The periodic rate. Oh, what happened? Why isn't it? Times 2, enter. And then periodic rate, half year rate, right? 6% divided by 2. Okay. And then let's find the bond price. So bond price is the, there are two components, right? Present value of annuity and the present value of single cash flow. So annuity formula is payment over R minus payment over R times 1 plus R, close parenthesis, raised to N, close the outer parenthesis. So that's the present value of all those coupon payments, right? Then plus not that one. Now the single cash flow, right? Present value of the single cash flow, the face value of the bond, N plus R to N. Okay. So here, then if, is everyone okay at this point? Everyone okay? Is everyone okay? Huh? Say something, there's no vital sign,
Yes.
Okay, Naomi, thank
Yeah,
you.
I'm good. I'm good.
Yeah, okay, Nicole and Noel, thank you for showing some vital signs. Okay. Um, where was I? Okay. So then hit enter now. You hit enter, and what did you get? Uh, did you all get this? $1,115.57. So, yes, is this a premium bond or discount bond? Of course, it's premium bond because the bond is priced or the bond is selling above its par value, right? And that we have, right? The same number, 1115. And now think about it. Uh, so this 1115 $50.57 is the sum of the present value. This is the present value of all those coupon payments, and this is the present value of $1,000. Now think about it. All those coupon payments, actually the present value of all those coupons are actually uh, greater than the present value of the face value 1,000. Right? Why? Think about it. Over 20 years, right? Over 20 years, you get $70 every month. $70 times 20, it's like 1,400. I mean, just simple, aggregation, right? Uh, and if you discount it 20 years back, obviously it should be greater than uh, just $1,000 discounted 20 years back, 20 years, 20 years discounted for 20 years, right? So, and also another reason is the coupon rate. Coupon rate, in other words, this bond is paying higher than the average or the prevailing interest rate. So it's just a superior uh, savings tool, right? Superior investment instrument. I'm not going to say superior to stocks, but in case of bond, any bond that pays better than the prevailing rate, better than the average rate in the market, that's a superior tool, investment instrument, right? All righty. Next. Uh, Well, what we just did was the rational price of the bond. In other words, um, finding the present value of the bond through the discount cash flow method. We are discounting the cash flow. That's the rational price of the bond. And the rational price of the bond uh, uh, is the same thing as intrinsic value. Rational price, intrinsic value, fair value, they all mean the same thing. Intrinsic value, rational price, fair value, they all mean the same thing. Because it is only rational, it's rational price because it is based on only the uh, predicted, future cash flow. In other words, there is no doubt about what interest this bond pays. As long as this bond, there is no question mark. As long as this bond is uh, uh, above triple B class, okay, meaning safe bond, right? Um, Now you don't worry when you put your money in the bank. You don't worry that the bank you will lose that money because the bank guarantees. And as long as the bank is in business, sometimes some banks fail. Some banks go out of business. Some banks go bankrupt, but hardly any in the U.S. Uh, uh, hardly any bank goes bankrupt. Even if they do, your deposit is guaranteed up to $250,000 by FDIC, right? Remember, FDIC is, Federal Deposit Insurance Corporation. It's an insurance. All the commercial banks have, all the commercial banks must be a member of FDIC, right? So even if the bank fails, then you have your money insured. And if it is such a, if it is such an iffy bank, right, you wouldn't bank with them. I mean, normally people use, banks like, Citibank or Chase or Bank of America or, I mean, is there anyone who uses any other bank, than these, banks that have, that are relatively well known? There may be some people who use very, unknown local banks, but then you are also risking, what if this bank goes, bankrupt, right? And then small banks, small unknown local banks may, they have higher risk, of course, but as long as they may go bankrupt, but as long as they are FDIC member, then your money is guaranteed, right? It's insured. The only thing is, maybe if they go bankrupt, you may not get your interest, but then think about it. Banks don't pay, especially these days, my savings account pays me like 0.8% a year. Who's going to put their money in, savings account? But if you put your money in a CD, probably you'll get about 1.5. Still, that's very paltry, very mediocre compared to the heydays of high interest rates. But the just like that, bonds. If you pick the companies that have higher than triple B and above, credit ratings of triple B and above, you're not gonna, it's very safe, right? Now, so if a company is very safe, it has, high credit ratings, the coupon interest they pay, you will never, they will never miss it. They will never miss it. And since this is a contract, they, the coupon interest is basically locked, right? That if they said, if the bond indenture is the contract. If the bond indenture says 8% coupon rate, it will have to pay 8% a year, right? So then cash flow from this bond is quite predictable, right? It's almost, definitive. It's not shaky or iffy or, uncertain. All of these cash flows are certain, right? They are certainty, right? So then, valuation of a financial asset is basically finding the present value of all future cash flows. So in case of bond, right, all these future cash flows are certain. They are certainty, right? So there is nothing uncertain, right? There's nothing gray. Everything is very clear. There's nothing in gray area. There's nothing gray. So then valuation by finding the present value of all these future cash flows, that is, a very rational way of valuing such an asset, a rational way of valuing such an asset, right? This method is called, discounted cash flow method. Of course, because you are discounting the cash flow. Okay, so that's how we find the. So I think the time is where is the 11:40, 11:54. So this is about a good time to take a break. So let's take a 10-minute break and reconvene at 12:05. Okay. All righty. Let's take a 10-minute and reconvene at 12:05. Right. All right, we're back. We're back. So let's go back to our Excel file, and let's take a look at what's this name? Later. So let's go to row four, right? And what is this? What is this about? Do you remember? Do you remember when we did the bond price quotes on news media, on print media, right? Bond price quote. You remember I said at the time that these examples were taken around June of 2010, right? I told you. And this wasn't, given anywhere. I mean, where do you see any clue? I mean, is there any clue that leads to that date? Yeah, to me, I see the clue, but it's not right in your face. But I told you I calculated it. In other words, there's nothing that says this example was taken in 2010, but I traced it back to 2010. How? Um, uh, let's take a look at this example. CIT, the corporate bond, right? A coupon rate 7%, maturity 2016, May 2016, last price $917.35, yield 8.8. That yield is what? 8.838%. That's the that's the discount rate, right? Think about it. This information was given, okay, and let me get rid of that minus sign. Okay. And this $917.35, that's the market price, the selling price of the bond, right? The selling price. So maybe, that N, maybe I want, I put N there to indicate that's the price selling in the market. But, this is okay. I mean, P would mean, anyway, price of the bond. That would mean, anyway, the selling price. So then think about it. What did I try to do here? I tried to find, N, right? How many years are left until maturity? I mean, think about it. Given the rate, given the discount rate, given the present value, given the future value, given the payment, we can solve for N, right? Once we solve for N, then the coupon rate is 7%. I didn't put it here, but we know it is 0.07. Right? It's given, right? It's already given. Right? It's already given. So the reason it is So in this example, everything basically is the same condition like, the problem we did before. But the only thing is T and yield, YTM, yield to maturity, only these two things are different. Then here's the, let's take a look. So let me just make sure everyone is everyone there listening? Is everyone listening? Angelica, are you there? Angelica?
I'm here.
Okay, great. Kiara, you are there too. Jeremiah, are you there? Jeremiah?
Yeah.
Good, good. Maricel, are you there? Maricel? Naomi, are you there? Naomi,
Yes, I'm
good,
here.
good. Yeah, I see you. Nicole, are you there,
I'm
Nicole?
here. Yeah.
Okay, great. I see you. Your microphone. Nikari, are you there? Nikari. Vivian, are you there? Vivian.
Yes,
Vivian.
hello.
Okay, great. Alrighty. And it seems like Noel is joining. Alrighty. So then,
Can you hear me now?
going back. Yeah, Nikari.
Okay.
Okay, I got you, Nikari. So here, let's get back to this example, row 4. So remember, we can find n, right? In other words, but this is a little more complicated problem because we have this is I mean, if it is just present value of annuity, only annuity or only single cash flow, we can easily find then. But this is the case where present annuity and single cash flow are combined. So it would be the formula would be more complicated, a little more complicated, but that's why we have Excel's built-in function. So using, think about it, if we can find n, that means the time left to maturity, and the maturity is this, then we can trace it back to when this example was taken, right? Makes sense. The time when the number of x number of years are still left to maturity. So using Excel's function, built-in function, and go to financial category, financial, right? And scroll down until you find n. Here we have n periods, right? N number of periods, right? Number of periods. So that's how. So hit OK and give it what it's asking for. And the rate rate is periodic rate, H4. There's nothing there, but enter it there. Later, I'm going to put, it's only a matter of, it's dividing this by 2, right? Payment. This is the payment. Present value. This is the present value. And you must enter this as negative. You must enter this as negative. But be careful. When originally I entered it already as negative. If it was already entered as negative, right? In other words, if you see parenthesis there, that means negative. I've been telling you there are 3 ways the negative number can be expressed in Excel. One is, of course, minus sign. 2, red font. 3, parenthesis. Okay. So in this case, since it is entered as positive, I'll have to put minus sign here. And the future value, of course, that's the future value. right? And then hit enter. And then you might say something like this. No, that's not correct. But as soon as something was missing here. As soon as you enter this, then it's going to change, right? Because there is no such thing as negative time. Time cannot be negative. And also this, if you, the reason I entered this, you understand, in financial calculator setting, one thing has to be cash outflow for the other thing to be cash inflow, right? And this one, think about it. This one is cash outflow, right? Think about it. If you are buying this bond today, if you buy this bond today, then on maturity date, right, May 2016, you will receive 1,000, which is cash inflow, and until then, every 6 months, you will get $35 as interest. So that's also cash inflow, right? For there to be cash inflow, there must be cash outflow first. That's why it was entered as negative, right? So then did everyone get the same result? So that means time to maturity is 11.71 semesters. 11.71 semesters. And in years, how many years is that? You simply divide that by 2. It will give you, it's almost 5.86 years. 5.86 years. Right? And then, now we can trace it back to when this time 0 is. In other words, when this example was taken. So then simply we need to subtract from this May of 2016, subtract 5.86 years. But be careful. All the calendar dates on Excel are basically, built on, is basically, counted by number of days. So, in other words, you cannot subtract just number of years from that. You must multiply it by 365 so that it will be number of days. Right? 5.86 years times 365 will give you number of days, and you subtract those number of days from May of 2016, and then you go to, that will give you June 2010. That's how I could trace it back to 2010, and I told you that's how I could figure out that this example was taken in June 2010. Okay, that makes sense. Okay, now our next question is then, how do we find the rate? Of course, we already know the first thing. So everyone got this?
Yeah, I got that.
Okay, good. Now, we know, in this case, we know how to, we know the periodic rate will be 4.42, yield will be 8.8, because we started out from this example, right? So we know we're not going to do that. And then, so we're going to move on to this example. Now here, we know yield is the discount rate, and yield is yield to maturity. Annualized yield means, annualized return. annualized return. And I explained the difference between the annualized return in scenario 1 and in scenario 2. Remember in the house value example. So I'm not going to go over that again. So yield to maturity is what they say. That's the long-term return, long-term annualized return if you hold the bond until maturity. And also, it's another name for that is internal rate of return. Internal rate of return is the return or the discount rate that makes the left-hand side of the equation equal to the right-hand side of the equation. What that means is, now think about it. What it means is all righty. Oh no, this one may be the other one. This one is better. Yeah, so we know the bond valuation formula, right? Now the bond valuation formula is, I will label it as B, which stands for intrinsic value of the bond, or the rational price of the bond, or the fair value of the bond. It's the combination of present value of annuities, of all the coupon payment. I'll just call it payment. Coupon interest payment. PMT. All the coupon payment. And the present value of the face value, 1,000, right? So we know, it's payment over R minus payment over R times 1 plus R raised to N plus 1,000, the face value, discounted, right? Now think about it. Internal rate of return means there is only one value, one discount rate, one number, right? Only one number that can make this right-hand side, this is called, that's the right-hand side of the equation, equal to the left-hand side of the equation. Isn't it right? In other words, when this is the unknown, let's say when we are solving for this, that means everything else is known. This is known. This is given, right? Payment is given. R is given. N is given. They are all known, right? But then so then we find the rational price of the bond. But what if when you are buying the bond, you have to pay the market price regardless of the intrinsic value, right? You have to pay the market price. Most of the, and I've been telling you, most of the times the market is irrational in the short run. In the short run, the market is irrational. In the long run, market is rational. So in the short run, a lot of things are, but in case of bond, in case of stock, especially in case of stock, the stock price fluctuates. Stock price fluctuates ever so frequently, even during the day. Goes up and down and up and down. It's like a crazy, volatility every day. And why is it? Why does the stock price changes so much? It's because the market is all triggered by all these noise. Market participants, in other words, who of course, there are more the institutional investors holding the total dollar value of what institutional investors are holding is a lot greater than individual investors holdings, dollar value of individual investors holdings. But individual investors are very fickle, and average Joe with not much knowledge, expert knowledge, or training in finance. So it's just like Bitcoin market. Who buys Bitcoin? A lot of young people who wants to make big buck. Quick. Who wants to make a fortune very quick. Who wants to make a big buck very quickly. But then something like Bitcoin is it's born to be a very volatile thing. It's a very speculative asset, and it's bound to be volatile. And every people who speculate in Bitcoin, they are easily swayed by even a minor noise in the market. So that's why it is so volatile. The stock market is also so that's why we need to know the intrinsic value. If you know the intrinsic value, but Bitcoin doesn't have any intrinsic value. Bitcoin doesn't have any intrinsic value. So it's nothing but that's why it's like a Ponzi scheme. It's a Ponzi scheme. Nothing but a Ponzi scheme. Only the demand supports it without any intrinsic value. But stocks do have intrinsic value because the company, at least the company has intrinsic value. The company's intrinsic value is based on its physical assets, right? Because think about it, when if the company has no debt, right? And if the company is dismantling, if the company is going out of business with no debt, then what will happen? The company will pay out all of its equity to the stockholders, and all of the equity value of the company is basically the value of all the physical assets and current assets. They will just simply divide it by number of shares, and they will have to pay it out to the shareholders by the percentage of shares. In other words, number of shares they hold. So there you have it. There's a physical value, intrinsic value of the company, right? But then in case of Bitcoin, where is something like that? There's nothing like that. But even in the stock market, in the short run, price is fluctuating because of these fickle investors who have just thin ears that get swayed by the noise. But in case of bond market, that volatility is much lower because in the bond market, everything is very clear. Unless the bond has unless the bond is the one with the very low credit rating, and the bonds below triple B credit rating is as risky as bond, as volatile as stock. But as long as the bond has credit rating above B plus and above, then it's a safe asset, and the interest it pays is quite safe, is secure. I mean, in other words, there's no way it's going to default on its interest. So the market price will most likely be the same as a rational price or intrinsic value. But let's say, but still, in the short run, the market price selling in the market can deviate from the intrinsic value. Okay, that's why there's a profit opportunity, because if the market price is undervalued, then there's a profit opportunity there. You buy that bond or you buy that stock. But anyway, even the bond may be slightly mispriced, mispriced. In other words, different from the intrinsic value, right? Deviating from the intrinsic value. So in that case, you have to pay that. You have to pay that price to buy the bond. There's no way around it. When you buy a stock or bond, you have to pay the market price, right? You cannot say, "Oh, that's not the intrinsic value. I'm not gonna pay anything more than the intrinsic value." There's no way you can buy it, right? Because the seller will take no less than their ask price, right? Let's say iPhone 13. We all know iPhone's intrinsic value is not. I'm not going to go. We're out of time. So think about it. When you pay the market price, which is the left-hand side of the equation, then there is only one number, one discount rate, right? I'll call that lowercase y, which means yield. Of course, this is half year yield, right? When I use, yield to maturity, that's annual, right? It's annualized. This is half year because, bond is on half year cycle, semi-annual cycle. There can be only one discount rate, one number, right? Only one number that can make the right-hand side of the equation equal to the left-hand side of the equation, right? And that's called, internal rate of return. That, one number that makes the right-hand side. Think about it. You discount all these future cash flows, and it must be equal to. It's supposed to be equal to the left-hand side, and then to make that equal to the left-hand side, which is the selling price of the bond, market price of the bond, there can be only one number that can make that happen, right? That's called internal rate of return, right? That's why. Internal rate of return. So let's do, okay. So maybe I'll, I better, change that to y, okay? So two different problems here. Maybe I won't change the notation because the formula we're going to use is rate formula. By using the rate formula, we can find this, right? And then this one is the market price of the bond. So let me make it market price of the bond. Let's call it, okay. Price of subscript. Okay, so let's do that. So finding use Excel's built-in function. What's the time? Oh, we're almost. So go down to rate. Give it what it's asking for. N period. There's N. Payment. There's payment. Present value. Here's the present value, right? There you go. It was already entered as negative, so you don't have to put negative again. Future value. Okay. And the type is always ordinary because bond is ordinary annuity, right? It pays interest at the end of every 6 months, not at the beginning. Okay. So we got that. There you go. So that's, but again, then that's 6 month half year rate. So you must multiply it by 2, turn it into annual rate. Okay, so our yield to maturity is 4.73. Okay, now I wonder what this was previously. Maybe I think it was related to no, not this problem. No. So that's all the time we have for today. Any questions? Any questions? Any questions, anyone? No? I'll take it as no. So that's it for today. Have a great afternoon, and I will see you on Thursday. It's a in-person day, right? I'll see you there, or all right. Take care, everyone. I'll stop sharing. All right,
So-
take care, Noah.
Professor.
All right, take care, Angelica and Nicole. I'll stop sharing.